China's 10-year yields are plummeting at an alarming rate, signaling an economy on the brink of a catastrophic implosion. What caught my attention this morning is the fact that China has now announced that they are no longer going to report on youth unemployment. Why? Well, because it's the youth that start revolutions. And they don't want us to know just how bad it is in China. Because China's financial situation is so dire that they're pleading with investment funds to stop being net sellers of stock, and also in their shadow banking sector, they are warning them not to sell products. It's so important that you realize how this impacts you, because we are all incestuously intertwined. And you gotta ask yourself, do you think our own government would ever keep things like this under wraps? I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. And you really better have a strategy, because the whole breakdown of the global economy is heating up, and China could very well be that flame. Let's just dive right in, because guess what? China, can you believe this, slides into deflation as consumer factory prices drop. Wow, for the first time since 2020, we certainly know what's happening in 2020. Take a look at this. That black line is CPI, so official inflation, thank you. And PPI, the massive drop in PPI, that's producer price index year over year. And we know if prices at the producer level are going down, well, yeah, it's also going to show that your CPI is down. But here's the reality. They need to accelerate all the government spending, raising government debt, and do coordinated monetary and fiscal easing to break this debt deflation trap. Right, so let's see. We've got a problem with debt, and the whole world has the same problem with debt. And what is the solution? More debt. Well, let's think about that. Has that worked? I mean, good God, look at Japan. They've been doing it since the early 90s. All of this stimulus, all of this debt, has it really stimulated the economy? No. So insanity is doing the same thing over and over again and expecting different results, and the whole flippin' world is doing the same thing. But I'm not really sure that they actually expect different results, or that they're speeding that up. China sends finance experts to tackle region's debt. So how did they do this? Well, Beijing raises pressure on provinces to deal with bloated balance sheets as the economy stumbles. Because in order to make it look like China was growing and growing and growing, they were building cities with nobody to inhabit them. We know that. We've talked about it so long. But the reality is it does not matter whether you are a government, a corporation, or an individual. The laws of economics works the same. You would, if you continue to take on that credit card debt, at some point you're going to have trouble repaying it. So you're just going to be accumulating interest and compounding interest. And number two, somebody's going to say, nope, no more credit. And we've already seen globally that the central banks, which is what used to happen in a failed economy, are having to buy back the debt, the new debt that the governments are issuing. So guess what? Even governments have their credit limits. And you can see in this particular graph, which starts out in 2000, and it's not a whole lot of volatility. And by the way, that is when China's currency, the yuan, pegged to the US dollar, and we built out, the US corporations built out the manufacturing sector in China. And you can see how it became more and more volatile because it is no longer pegged. Now China's currency is free floating against the US dollar. Once they got lifted off, China's new loans in July dropped to the lowest level since the global financial crisis. And that again goes all the way back to 2000. Well, what does that mean? That means that demand is slowing. The enormous debts accumulated by China's provinces have become an urgent problem for policymakers as they try to end the country's long reliance on a debt-fueled infrastructure binge to drive economic growth. One Goldman Sachs estimate puts the total local government debt pile at 13 trillion, including the liabilities of the off-balance sheet entities known as local government financing vehicles. So yeah, when you first go and get a credit card and you go shopping, it looks like your economy is doing really well. But at some point, you always pay the piper. And by the way, that is merely a guess, because all of that off-balance sheet, so much of that is hidden, nobody can see. And that's true in China. And oh, by the way, that's true in the US as well. And so the question is, have they hit their limit? Because their home sales, which is a big driver of the Chinese economy, like huge, even more than the US, drop most in a year as the slowdown worsens. Sales of biggest developers dropped 33.1% from a year earlier. Slump is a blow to cash-strapped builders in this economic recovery. This is a huge big deal because those developers depend on new money. It's a Ponzi scheme. It's all a Ponzi scheme. The whole fiat system is a Ponzi scheme. But these developers are counting on that new money to pay for the old money. So when you see a drop like this, it is a very, very big deal. And that economic boom that they expected once they lifted the lockdowns really has not materialized. Existing policies have so far failed to sustain a housing rebound, putting the government's 5% annual economic growth target at risk. My goodness. Home prices have resumed falling while property investment continues to shrink. Here you can look at it in a different way because the local authorities, so government authorities, are counting on the revenues that they got from land sales to prop up their books and keep hidden all of that debt. So yikes, we've got a double whammy. We've got the developers and we've got the local governments. I think we've got a big, huge problem, or China does. China's stalling economy puts the world on notice because if China gets a sneezes, the whole world gets a cold because we are all incestuously intertwined. As China's economy flashes indications of decline, the consequences pose perils for countries around the globe. Because over the past decade, China, now listen to this data here, China has been the source of more than 40% of global economic growth. 40%. The US is 22% and the EU is 9%. So China has been what's made the global growth appear to be okay. They provided 40% of the global growth after this last decade. Long the centerpiece of a profit-enhancing version of globalization, China has devolved into the ultimate wild card in a moment of extraordinary uncertainty for the world's economy. We are all in trouble. No matter where it starts, it's going around the world. Their trade plunges more than forecast in a blow to recovery, and that recovery after the lockdowns simply did not materialize. I mean, exports dropped 14.5% year over year in July, and imports fall 12.4%, much deeper than what was expected. This is what it looks like. Okay, so the black line are exports, the red line are imports, and they are both dropping precipitously. Shipments to the U.S. plummeted 23.1% in July, according to the customs data. Exports to other markets, including Japan, South Korea, Taiwan, ASEAN, the EU, Brazil, and Australia, all dropped by double-digit percentages too. What do you think that's really telling us? It's telling us and showing us that demand around the world is falling, that deflation around the world is growing. And guess what? There's only one way to fight deflation. That's with inflation. It makes it really simple. It's not like you got 1,000 choices. You don't. You have one.